as much as we had hoped that MTD for ITSA was being
ATSA?
ITSA, so that's income tax self-assessment.
Self-assessment again, yes.
So that's again this swinging back to anyone with sales of £50,000 or above. That's your income before you take any of your costs off. 50,000 and above will be automatically enrolled in MTD for ITSA, which is making tax digital, income tax self-assessment. Which means you've got to file every 3 months. You've got to file your income, your expenses, and you've got to break them down as to what each sector and stuff like that electronically with HMRC. You can't do income of 8,500, expenses of 4,000. You've actually got to break down each and every sector into the right fields for HMRC. It then calculates an estimated tax based on those profits or losses in that period, and then that gets filed with HMRC every 3 months. And then at the end of the year, you do one big file where it pulls everything together that you filed previously throughout the year, and then you do one submission through that, ideally taking you away from self-assessment tax returns. But I think for the first year, possibly 2 years, it's going to be twinned with that as well. So it just gives you that chance. On the beta testing, it does pull in your other income sources. So if you have paid your
savings,
well, at the moment, yes and no. They can be a bit hit and miss.
Okay. So that might still need to be an annual.
Yeah, it still needs to be an annual catch up. But then again, you can add that into the annual submission as well as a separate line. There are a few exceptions. So if you're digitally excluded, again, they haven't released the framework as to how you would be classed as digitally excluded. They have given some very, very weak and meek sort of guidance towards it. And then I think also if you're a minister of religion, you are exempt as well. But pretty much most other people will be dragged into this. So that's if you've got self-employed income of £50,000 or more. Partnership, your share of the partnership is £50,000 or more. It doesn't affect limited liability partners at the moment. And again, I'll cover an eyes on that. Also any property landlord as well. So even if you share your the property as well, it's your share of that property income. It's over 50,000. That's for 25, 26, then 26. 27 it drops to 30,000. Wow. And then 27 to 28 it drops to 20,000. So it's going to be pretty much everyone's going to be included in that. So that's the current roadmap we're looking at. It's not ideal, but again, you can see the HMRC's and the government's push for digitisation of tax, so they know where everything's going, what's happening, and all this sort of stuff. At the moment as well, there is a little sneaky thing in here where they are looking at aligning with where HMRC wants to try and collect tax at source a lot quicker. So if you've got self-assessment income and you're a pay-as-you-earn employee, they are looking to try and collect your income tax through your pay-as-you-earn code as well throughout the year through your self-assessment. So again, that would twin nicely with seeing what you're getting every 3 months. So therefore, they could then start looking at adjusting your personal tax-free allowance, your tax code in your pay-as-you-earn job, to then bring in the tax from that. There are
helps their cash flow.
Yeah, helps their cash flow. Certainly doesn't help yours, unfortunately. But again, we are effectively slave masters to the HMRC. I'm sorry to say it, but we are. Yeah, we knew that. There's no two ways about it, unfortunately. So.
And we mentioned savings there. What were the impact on savings? Because there were a couple of elements there, weren't there?
Yeah.
Well, I can